Today, I want to talk about how the banks are now not only predicting a market crash, but they're even preparing for one. They very quickly changed their tune from soft landing to crash worse than 2008. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Bob Mitchell, JP Morgan's chief investment officer, was on Bloomberg a few days ago talking about the Fed's emergency bailout facility and the liquidity crisis in banks. Bob Mitchell specifically mentioned Truist Bank and how likely they are to collapse, and also mentioned that a big bank is betting the VIX could go to 180 points. First, let's explain what the VIX actually is and explain what a prediction of 180 points would actually mean for the market. So the VIX is a volatility index tracker that effectively tracks volatility in the S&P 500. Basically, it tracks how fast the market is moving downwards or how strong and how convicted the market is when moving upwards. During panicked scenarios such as March of 2020 and late 2008, the VIX spikes when the market crashes. Back in March of 2020, the VIX spiked to 66 points and hit intraday highs around 80 points. Back in 2008, the VIX spiked to around 80 points and hit intraday highs of around 100 points. Considering some traders, or a big bank specifically, is betting the VIX will go to 180 points, that means they're expecting a crash worse than 2008 and 2020. They're expecting the market to crash faster and harder, almost twice as fast and twice as hard than 2008. As you can see from this article, it says some traders bet Wall Street's fear gauge is due for a 1,100% jump. This actual confirmed bet implies the VIX will reach unprecedented highs. Now I wonder what kind of other stocks will reach unprecedented highs if the VIX jumps to 180 points. It says the trade shortly after the start of regular market hours last Thursday implies the VIX will climb 1,100% in the next 5 months. And it says the same trader or others have opened more than 20,000 contracts of open interest in VIX December options with the same strike price. And it says if the VIX does the unthinkable and hits 180 points, then the options will be considered in the money, thus worth something, and somebody somewhere makes a lot of money. And obviously if you've seen tweets from Unusual Wells, who often tweets about unusual options activity, somebody somewhere always knows something. And as Robert tweeted, he said it seems the apes were right all along, because this article says that hedge fund bets could spark turmoil in US treasuries. You can currently get a guaranteed free share of Tesla or of Google and up to 15 free shares on top of that, worth up to $2,000 each, which you could always use to buy more shares of AMC, GameStop or of any other stock. All you have to do is sign up to Moomoo using the link in the description below and make the required qualifying temporary deposit. Signing up to Moomoo is free and it's easy, it just requires that temporary deposit, but it's a really great way to help support the channel. And on top of that, Moomoo is very easy to use. They've got tons of technical indicators and advanced charting tools and their own options trading platform, because short positions in the 2-year Treasury futures reached record highs in August. Again, this article isn't written years ago talking about August many years ago. This article was written yesterday. And it says a build-up of leveraged bets has the potential to dislocate trading in the $25 trillion US Treasury market. And it says the current build-up of leveraged short positions in US Treasury futures is a financial vulnerability worth monitoring because of the margin spirals it could potentially trigger. You'll note in my video earlier I mentioned that some of these major banks have absolutely ridiculous leverage ratios. You'll remember these leveraged positions were in derivatives, many of which were derivatives on the Treasuries market, like Treasury futures. So even small movements like a 2, 3, 4 or 5% movement in treasuries could end up liquidating a major bank like Goldman Sachs. And obviously small movements can lead to larger movements with the help of margin deleveraging. Saying margin deleveraging, if disorderly, has the potential to dislocate core fixed income markets. Basically, these hedge funds are taking up massive leverage shorts in US Treasuries, but if the US Treasuries start moving up, these shorts will have to unwind their short positions, pushing the market up even higher. and that unwinding of the short position or deleveraging of the margin they are using, aka reducing that leverage, could be disorderly. And potentially this could be the trigger that sees the VIX skyrocket to 180 points, making this one big bank or one trader tons and tons of money. But I also wanted to show you this video from 2020 explaining how Citadel should have gone bankrupt back then. This is obviously before January of 2021, explaining Citadel should have gone bankrupt long before.
If you know that when it goes tits up on you, when the trade goes bad on you, they're going to come bail you out, right? I mean, look at Ken Griffin, right? He runs Citadel, okay? He should have been bankrupt.
He should have been bankrupt.
He should have been bankrupt. But I've been told by a good source, could be wrong, but it's a good source. As you know, Ben Bernanke is on his board of advisors. Ben Bernanke is paid $20 million a year by Citadel. That's what I've been told. I don't know if it's true. It's a rumor. But it would make sense because when the things flipped in March of 2020, he was
this GameStop?
No, I mean, he may have been involved there too. I don't know his role.
There was another firm that were backed up after GameStop because they were
possibly.
Yeah,
I'm not as familiar with that one. But going back to the when we went into a crash in March of 2020, there were swap lines given to these guys. The risk parity trade was protected. Very much like what happened over here when all your LTI stuff blew up, right?
Yeah. Or is this what happened with Silicon Valley Bank?
Well, that's a whole nother story.
So that was basically saying that Citadel should have gone bankrupt back in March of 2020, obviously during the pandemic, but they received swap lines and loans from the Fed, effectively once again being rescued when they really should have just been left and hung out to dry. But as Biotech Moose tweeted, he said, ultimately we will win because shorting a company that is not going bankrupt is sheer stupidity. He said right now nothing will happen until AMC reaches a tipping point with its profits, saying movie and merch revenue is increasing and debt is being repaid, and AMC will eventually flip. And he said at that point, when AMC is making money hand over fist in terms of profits, the street will go long AMC and nothing will save the shorters. Yes, we know Citadel has orchestrated a massive short position on AMC, likely to the tune of tens of billions of dollars, obviously shorting the float multiple times over. But obviously when other Wall Street firms like BlackRock and Vanguard come in not with tens of billions of dollars, but with hundreds of billions of dollars, those shorts will be hung out to dry. You have to remember that even though Citadel is big, they're not that big in the grand scheme of things. And speaking of those firms like Vanguard and BlackRock, they held all the way to the all-time high and have held ever since. And Vanguard have just bought more shares on the 31st of August 2023. You can see from this chart, institutions started buying in back in June of 2023 and have pretty much increased their positions ever since. Yes, we can see this drop off, but that was obviously with Antara selling tons of their shares, but specifically Vanguard and BlackRock have added even more. Vanguard and BlackRock continue buying up more and more shares, and as Biotech Moose tweeted, he said at some point it will flip. At some point, BlackRock and Vanguard will decide they hold so many shares of AMC that the stock must go upwards and burn the shorts on the way. Now finally, I also wanted to talk about this tweet from Hang Loose about the new AMC proposals. There's a variety of different proposals. 1, 2A and 2B are all to do with changing directors around. 3 is to eliminate the prohibition against stockholders acting by written consent. 4 is to remove the limitation on stockholders' ability to call special meetings. Number 6 is to reappoint the auditors, and number 8 is just a housekeeping proposal in case they have any additional proposals in the future. Now all of those ones I would agree to, but there's actually 2 I'm inclined to disagree with. The first one is around compensation of named executive directors. I haven't actually seen the details, but I don't really think those directors need any more pay rises. And the other one, which is specifically what Hang Loose touches on, is proposal number 5. Number 5 is to expand the exculpation provision to limit the liability of certain officers. But as Hang Loose tweeted, he said, why has a proposal been created to make AMC board members safe from being sued from wrongdoing? He said if these directors just don't do anything wrong, they've got nothing to fear about. But seeing them wanting such protection makes it seem like they're going to need it for some reason in the future. But he says, and I say, we should keep them accountable. Obviously, I can't advise you how to vote on these proposals. That's a decision you need to make alone. But I do think Hang Loose raises a great point, which is if they don't plan on doing anything wrong, why do they need to be exempt from liability? But guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.